Hey traders, Nick Shaheen here actually answering a question about Amazon. I was asked, how do I go long Amazon cheaply here? Well, obviously, you've heard the news. They're buying up the world, Whole Foods. And, the stock today caught a downgrade from somebody. Regardless, Amazon has been doing this for ages. This is a weekly chart. If you go back a decade and you connect those dots right there, it shoots over to here. And when I said this was a target, I was called crazy. Regardless, look at where it is right now. So back to the 1 year daily chart. And that's what we're talking about. Okay, so how can I go long without being exposed at $1,000 a share right here and then? You can use options. Options, you can buy calls. Call options give you the right to buy a stock at a certain price. So instead of investing $1,000 buying the stock outright, and you're at risk right here, right now, you can invest. I can buy some calls that are a lot cheaper, still expensive in relative terms, but $40, $50, $20, $30 a call contract, which would represent 100 shares, for example, is a lot less money to risk than a full-blown $1,000 a share. So there are ways to even cut that down lower. And simply put, I can, speaking of puts, I can sell puts into the stock provided, and this is a huge, huge important point, is I'm willing and able to own the stock. So if I'm not, then I don't do this ever, because that opens me up to all kinds of losses. So for example, if I missed it and I wanted to go long here that day, I can sell puts here and collect money. And I'd be long Amazon because if nothing happens, those puts will expire worthless for maximum profits in my pockets. The money I collect right now, it stays in my pocket. So for example, if I wanted to go out to September and sell puts at a lower level than current, so let's say arbitrarily, not arbitrarily, I just mentioned 920. If I take 920 and I say, okay, I want to sell that put, I can collect $19 a contract. So one contract gives me $1,900 in my account today. And what does that do? That commits me to buying the stock at $920 a share. So I'm basically getting paid for a chance to buy Amazon at a discount from current price. So if this is current price, eyeball discount would be 7% discount. So you can see how this could be a way to enter the stock. How could I make this even better? If I'm really upside, if I really think it's going to go higher, I use that money that I collect today to offset the entry cost into calls. So I'm spending, say, $20 or $30 a contract for longer dated calls to be long Amazon, but I'm collecting this much money here. So the overall out-of-pocket expense is smaller than it was if I didn't sell the puts. Now, if I don't want to own the stock, I can sell put spreads, meaning I can sell the 920, buy the 910 or 900 to limit my risk, collect the premium. I'm still bullish Amazon, and I don't need it to rally to make money. All I needed to do is stay above my sold strike. So if I sell the 920, if it stays over 920 by a penny, boom, the whole shebang is in my pocket, stays in my bank account, and I made money on the stock without even having to own it. So there's tons of ways of doing it. The most aggressive way of doing it, by aggressive I mean that I'm very bullish Amazon if I want it to be. I sell the puts, buy the calls, and then if I know what I'm doing, I can sell covered calls. What does that mean? So if I buy the September calls, now it's an asset. I can sell calls against it without opening myself to shorting a stock. Like when you sell calls, which I never ever do in stocks, that opens me up to unlimited losses. Why? Because I'm essentially saying I'm short the stock at whatever level. Because when I sell a call, I commit to shorting the stock if price goes through that. So I don't want to ever do that. So I don't mind going long a stock on dips, but I don't want to ever be short a stock on a spike. So, but if I own a put that's longer than the call I'm selling, then I'm not open to that risk, because if it goes to 1 million, I'm covered 100%. I can still make my money. So there are nuances. The most aggressive way of going long is selling the puts, buying the calls, and then putting those calls to work by selling covered calls against them as time goes by. Meaning, if I buy the September calls or next year's calls, I can sell weekly calls against those or monthly calls against those to lower my entry cost eventually. All this is kind of complicated. Sounds complicated, but it's really easy. If you have any questions, let me know. Nick signing out.